Good day, and welcome to the D-Marq-AnalyticS channel. In this week's video, we will look into an interesting topic, value investing strategy, understanding three ratios. Today, we're breaking down three of the most important ratios in value investing: the forward PE ratio, the PEG ratio, and the PEGY ratio. If you've ever wondered, is this stock expensive, or am I buying at the right price? These ratios help you answer exactly that. By the end of this video, you'll know how each ratio works, when to use them, their limitations, and how to combine them to make smarter, more disciplined investment decisions. Let's get into it. Section 1. The forward PE ratio. What it is. The forward price-to-earnings ratio, or forward PE, is a valuation metric that compares a company's current stock price to its forecasted earnings over the next 12 months. It's the forward-looking version of the traditional PE ratio. The formula is forward PE equals current share price divided expected EPS over the next 12 months. Why it matters. It tells you how much investors are willing to pay today for future earnings. It's especially useful for companies with rapidly changing earnings, like tech, cyclicals, or turnarounds. It helps you compare companies with different growth trajectories. Important note: because it uses estimated earnings, the actual PE over the next year may differ. Analysts revise estimates constantly based on new earnings reports, macro conditions, company guidance. So the forward PE is a forecast, not a guarantee. Example. Imagine company A trades at $100 per share, and analysts expect $5 EPS next year. Forward PE equals 100 divided by 5 equals 20. The calculation unfolds dramatically. 100 divided by 5 equals 20. This means investors are paying $20 for every $1 of next year's earnings. Is that good or bad? It depends on growth, which brings us to the PEG ratio. Pros: forward-looking, not backward-looking. Useful for growth companies. Helps compare companies in the same industry. Cons: analyst estimates can be wrong, can be misleading during recessions or booms. Doesn't account for growth rate. Which leads us to the PEG ratio. Section 2. The PEG ratio. What it is. The PEG ratio adjusts the PE ratio by factoring in the company's earnings growth rate. It answers the question, am I paying too much for this company's growth? The formula is PEG equals PE ratio divided by EPS growth rate. Understanding EPS growth. EPS growth is based on diluted EPS, which assumes all convertible securities are exercised, convertible debt, preferred shares, options, warrants. The forward growth rate, which is a compounded annual growth rate from the most recently completed fiscal year's EPS, FY1, to analysts' consensus EPS estimates for 2 fiscal years forward, FY2. This gives a more realistic, forward-looking growth expectation. Interpreting PEG. PEG less than 1, potentially undervalued relative to growth. PEG equals 1, fairly valued. PEG greater than 1, potentially overvalued. Example. Company B. PE equals 30. Expected EPS growth equals 20%. PEG equals 30 divided by 20 equals 1.5. This suggests the stock may be trading at a premium relative to its growth. Pros: accounts for growth, unlike PE. Useful for comparing high-growth companies. Helps identify overhyped stocks. Cons: growth estimates can be overly optimistic. Not ideal for companies with inconsistent earnings. Doesn't consider dividends. Which leads us to the PEGE ratio. Section 3. The PEGY ratio. What it is. The PEGY ratio expands the PEG ratio by adding dividend yield into the equation. This is especially useful for dividend-paying companies, mature businesses, value investors who care about total shareholder return. The formula is PEGY equals PE ratio divided by EPS growth plus dividend yield. Why it matters. Some companies grow earnings slowly but return a lot of cash to shareholders. PEGY captures that. Interpreting PEGY. PEGY less than 1, potentially undervalued. PEGY greater than 1, potentially overvalued. This is not a rule, it's a signal. Example, Company C. PE equals 18. EPS growth equals 8%. Dividend yield equals 4%. PEGY equals 18 divided by 8 plus 4 equals 18 divided by 12 equals 1.5. Company D. PE equals 18. EPS growth equals 8%. Dividend yield equals 10%. PEGY equals 18 divided by 18 equals 1.0. Company D may be more attractive because the dividend compensates for slower growth. Pros. Great for dividend investors. More holistic than PEG. Helps identify value in mature companies. Cons. High dividend yield can be a red flag. Doesn't account for payout sustainability. Still relies on growth estimates. Section 4. Putting it all together. Here's how disciplined investors use these ratios together. 1. Start with forward PE. Is the valuation reasonable compared to peers? 1. Move to PEG. Is the valuation justified by growth? 1. Use PEGY for dividend stocks. Is the total return, growth plus dividends, worth the price? 1. Look for alignment. A stock might be attractive when forward PE is below industry average, PEG is under 1, PEGY is under 1. You understand the business. You believe in its long-term prospects. 1. Avoid over-reliance. Ratios are tools, not answers. They should complement cash flow analysis, balance sheet strength, competitive advantages, management quality, macro conditions. Section 5. Actionable takeaways. For our wonderful subscribers, kindly take note of the following. Use forward PE to understand valuation today versus expected earnings. Use PEG to avoid overpaying for growth. Use PEGY to evaluate dividend-paying companies more holistically. Ratios are starting points, not final decisions. Always combine quantitative metrics with qualitative research. If PEGY less than 1 and you believe in the business long-term, it may be a good entry point. If PEGY is much greater than 1, consider waiting for a better price. If you found this week's topic interesting or helpful in any way, kindly hit the like button. Share this video with someone who's trying to become a smarter investor. Please feel free to subscribe if you'd like. We would like to thank you all for staying till the end, and we wish you all have a wonderful day ahead.